Volatility in global markets is skyrocketing. The VIX, also known as the fear index, has gotten to levels that rival what we saw during the GFC. The question is why? Well, what you're hearing on the mainstream media doesn't tell the whole story. So right now, I'm going to explain why volatility, or the real reason volatility has been going parabolic in 3 simple, fast steps. Step number 1, let's go over the infamous yen carry trade, or maybe better said, the unwinding of the yen carry trade. We'll start with everybody's favorite. Oh, I forgot to put his name up there. Well, you guys know who that is. That is Slick Rick himself. And Slick Rick usually putting together derivatives like CLOs. More on that in just a moment. In this case, his other side hustle is the yen carry trade. So what he does is he goes to a bank in Japan and says, wow, I can borrow yen at 1%. These aren't actual numbers, it's hypothetical for the sake of the example. And boy, oh boy, I can borrow these yen super cheap. Let's say 1%. I could take these yen, turn them into dollars, and then I can go buy a dollar asset, which I think will give me a much higher return than the 1%. So let's say Slick Rick borrows these yen from a bank in Japan, then he takes them, turns them into dollars, buys NVIDIA. He gets those shares of NVIDIA because he is expecting a 2% return. Again, not real numbers. So he would pocket that 1% spread. Well, this works all day long. Let's just keep doing it, doing it, doing it. In fact, let's borrow the yen and then borrow even more dollars and then borrow against the equity that I have with the NVIDIA shares. What could possibly go wrong? Well, we're going to go over that right now. To keep things easy, let's say that the yen is equal to $1 to start. Not even close, but let's just say that it is. And let's say Slick Rick borrows 1,000 yen, and let's assume his monthly payment is about $5. Okay, fine. Well, what are his risks? Well, first and foremost, FX. The exchange rate could change between the yen and the dollar. Now, all of a sudden, he has a negative carry because he doesn't have enough to cover the cost of his payments for borrowing the money to begin with. And what exacerbates the problem is if interest rates go up and at the same time, the yen appreciates against the dollar. You can see how this yen carry trade unwind can have devastating consequences. And this is why many in the marketplace always refer to it as picking up nickels in front of a steamroller. But we're not done yet. Let's assume for a moment the assets Slick Rick buys, in this case NVIDIA, go down by 20, 30, 40%. Well, this could trigger a margin call with the bank that forces Slick Rick to sell just so the bank can cover what they lent to Slick Rick to begin with. So you have all of these things happening at the exact same time, which lead to this unwind. And all these things together put Slick Rick into a position where he's absolutely forced to sell those dollar assets. And this is one, I repeat, just one reason why you're seeing volatility spike in not just the United States, but in global markets. Oh, but wait, there is more. We talked about the concept behind this unwind, so you guys can kind of get your head around it. But now let's go over the severity and what has happened in a very short period of time, which has put Slick Rick in a very, very compromising position, to say the least. Let's go back to March of this year, all the way to today's date. On the left, we go from 140 up to 160. This is USD versus yen. So again, these were all just numbers for the sake of the example to keep things easy. In reality, going back to March, it took 150 yen to buy $1 US. So as this blue line goes up, that would represent the yen weakening against the dollar because you're needing more and more of those yen to buy just one greenback. So let's check out where we were right around here. This is when the BOJ, or the Ministry of Finance, had to intervene in the market because the yen was getting so weak. But then the market participants calling their bluff just makes the yen go lower. In other words, you need more and more and more yen to buy that $1 to the point where we got over 160. But look at what has happened in a very short period of time. We have collapsed from 160 all the way down to the low 140s. And this, among many other things, is what catches Slick Rick way, way, way off sides, to where it's not just a forced liquidation, but there's also issues that involve the global monetary system and globally systemic banks. More on that in just a moment. Step number 2. Now let's look at this through the lens of the Japanese banks. More specifically, what's happening with the Japanese banking stocks. But look at this chart of the Japanese banking sector. So it goes way, way up as far as an increase when they're increasing rates, the BOJ, because everyone thinks that's great for banks, but they don't really understand what's happening beneath the surface. And then we just get a complete collapse. I mean, this is a Wile E. Coyote moment right here. We're starting August 1st. They start to just tank. There's no other word to describe it. I mean, here are 4 of these major banks, globally systemic banks in Japan, just being shellacked. So starting off, the article says Japanese bank stocks were pummeled during Monday's market swoon, but the recovery Tuesday was tepid at best. Very, very crucial. Japanese Topics Banks Index gained only 3.9% Tuesday, only partially reversing Monday's worst in a generation 17% fall in the index. To give you some context, the overall Nikkei increased by about 10%. So they say one explanation is they had recently rallied on the BOJ's decision to increase its benchmark rate. Everyone thinks this is good for banks because it steepens out the yield curve a little bit. And usually the banks make their money by borrowing short and lending long. So they borrow at short-term interest rates, which are usually lower, and then they lend at longer-term interest rates, which are usually higher. They pocket the spread. But now, with expectations for another Bank of Japan rate rise now in tatters, I would say a possibility of the Bank of Japan doing a complete 180 and actually cutting rates just weeks after they raise them, bank investors are left with little hope of fatter margins. Another worry, I think this is much, much more important. I don't think this has much to do with just a huge sell-off because of the BOJ. They say, will the market swoon itself boomerang back on any of the banks? A weird way to say it. Through soured loans to traders, in other words, Slick Rick, or companies overseas. So what if Slick Rick gets himself into a position where he can't pay that loan back? Well, he defaults, and that blows a hole in the balance sheets of these banks that are collapsing when you look at their share price. But there's another reason, probably a more important reason, why some of these Japanese banks have lost over a quarter of their value in just a few days. And I'm going to reveal that to you right now. Step number 3. Now let's look at the U.S. economy, and then we will connect the dots between what's happening with the U.S. economy, the Japanese banks, and how this is being reflected in their share price, and the volatility in global markets. Let's start by looking at a chart going all the way back to September of 2023 to today's date. On the left, we go from 3%. I forgot to put the percent there. Pretend there's a percent sign there. We go from 3% all the way up to 4.8%. These are credit spreads. So just basically the difference between an interest rate on corporate junk debt, which just means that corporations' debt that isn't at the level of investment grade, and the corresponding treasury yield. So we want to look at these spreads. Why is that important? Because when you see these spreads blow out, it's a signal the market uses to know there's real problems underneath the surface. Now, this indicator in and of itself doesn't necessarily mean that you're in a recession, crisis, hard landing, black swan event. But you have to consider these credit spreads along with all the other data to come to a conclusion as to what the probabilities are that we are in the middle or on the brink of, let's just say, a hard landing. So, before we get into these credit spreads, the specifics, let's go over some of the macro data with the U.S. economy that would tell us that we're likely headed into a recession. Again, there are no certainties, there are only probabilities. Just some 30,000 foot level stuff. First of all, the 2s and the 10s, the yield curve has been inverted for over 2 years, and just the other day, it uninverted. And it uninverted due to a bull steepener, which is the bad kind. That's the bond market telling you that it expects future growth and inflation to be a lot lower, therefore interest rates to be lower, because the underlying health of the economy is extremely poor. And usually when you see this invert or uninvert, it just does it very quickly and then goes right back to where it was. But over the next few weeks, it gradually gets closer and closer and closer until you see that full uninversion. And then, if we look at history, we can see that usually we get that recession after the 2s and 10s have not only uninverted, but have uninverted for a sustained period of time. Next, we have a lot of the economic data that we're seeing become very, very soft, such as the job numbers. Just the other day, expecting 185,000 new jobs for the non-farm payroll report. We got 114. Let's keep in mind that almost every single month for the past couple of years, it has been revised downward. So next month, the probability is high that that 114 will get downwardly revised even lower, which would mean the unemployment rate would shoot up higher than it already did. When we got that bad jobs number, let's remember the unemployment rate went from 4.1% up to 4.3%, which triggered the SOM rule. And for those of you who may be new to the channel, the SOM rule is an indicator that has predicted every single recession going back to the 1950s with 100% accuracy. And it's basically when we see a 3-month moving average of the unemployment rate go up by 50 basis points from its trailing 12-month low, this triggers the SOM rule. And again, every time going back to the 1950s, we have been in or very near a recession when this line in the unemployment sand is crossed. And then, of course, there's everyone's favorite systemic risk, and that's good old commercial real estate. Who knows how much of this garbage is still in the balance sheets of the banks in the United States, but we see this bubble blowing up right in front of our own eyes. The bottom line is I could go on and on and on for the next 30 minutes on how the U.S. economic data is becoming worse and worse and worse, increasing the probabilities that we are headed for a hard landing. But let's get back to what's happening with these credit spreads. We see in 2003 they shot up, and if this chart, in fact, editor, why don't you zoom out? We can see this chart was way up here, kind of comes down, and you would expect that with the banking crisis that we had in 2023. But let's focus on the beginning of 2024 all the way to July of this year. We see credit spreads go straight down. They're compressing, which would tell you that the market sees that there's very little risk. In fact, the risk is actually decreasing. We'll just use this guy, Jim Cramer, as a proxy for the marketplace, and he's going out there and telling you to buy, 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 buy. Buy, 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 buy. Forget this inversion of the yield curve. It doesn't matter anymore. The yield curve is dead. This time it's different. And we can tell it's different because credit spreads are compressing. And if there was any danger whatsoever, credit spreads would be blowing out. Okay, well, what Jim Cramer doesn't understand is what's happening underneath the surface. So let's go back to the Japanese banks. In this case, we've got an N right here, and this is for Norinchukin Bank. And I've talked about them in several videos in the past couple months. But basically what happened is Norinchukin Bank, which represents a lot of these Japanese banks, and we see that playing out in their share price right now, got themselves into some real hot water. From a standpoint, they are borrowing all these dollars. It's another form of a carry trade. And they were borrowing them way back in 2021, 2022, let's say, when interest rates were a heck of a lot lower. Let's say they were borrowing in, or the end of 2020, end of 2021, when interest rates were zero. So they were borrowing at, let's say, 1%. And they were taking all of those dollars and they were buying treasuries, receiving 3%. Well, that works. You're getting a 2% spread. But what happens when the Fed jacks rates up to 5.25%, and you have to roll over that debt? Because remember, it's short term. This debt could be maturing every month, let's say. So now all of a sudden, their dollar funding costs to keep those treasuries is 5%, but they're only receiving 3% yield from the assets they own. Well, once again, this is a negative carry, which puts them in a very precarious position, just like Slick Rick in step number 1. Oh, and by the way, speaking of Slick Rick, he ironically is part of Norinchukin's bank solution. So since they have this negative carry, they have to sell these treasuries. They don't want to sell them, but they have to sell them because they need an asset on their balance sheet with a much higher yield than their dollar funding costs, so their costs to borrow the dollars to begin with. So they sell all these treasuries at a huge loss, and then they go over to Slick Rick and say, Slick Rick, do you have any products for me that would yield over 5%? And he says, oh, absolutely I do. In fact, I have these things called CLOs, these derivatives. They're amazing. What I do is I go out into the corporate bond market. In fact, I buy a lot of junk debt, or I lend to these corporations, which would not even be close to investment grade because they're a very, very high risk borrower and they can't get money from a normal bank. Then Slick Rick takes all of these loans and he divides them, he kind of chops them up into tranches. I'm sure you've heard this term before on movies like The Big Short. Remember when they're playing that Jenga game? Editor, maybe go ahead and throw up a quick clip there.
The modern ones are different. They're private, and they're made up of layers of tranches.
And when they take out that bottom piece of the Jenga puzzle, the whole thing comes crashing down. Well, you can thank Slick Rick for those CLOs, but the benefit, well, maybe short-term benefit, perceived benefit to Norinchukin Bank is Slick Rick has one of these C tranche CLOs that actually pays 7%. Well, this is great news. So, so Norinchukin Bank takes that C tranche, basically toxic sludge, and puts it onto their balance sheet. Now the asset side yielding 7% and the liability side 5%. So they're pocketing that tidy 2% spread once again. But you guys see the risks here, right? Let's go back to credit spreads. And what have they been doing lately? They have been blowing out, which tells you that the risk for those underlying assets is going parabolic. The underlying assets, which the Japanese banks now own, courtesy of Slick Rick. So just to make sure we're all on the same page, let's look at a doom loop or a feedback loop that I think is the major contributor to what we're seeing in the volatility in these global markets. And now we are connecting the dots with everything we have been talking about on this video. So the economy starts to decline. And then the market realizes that, wait a minute, bad news isn't good news. Bad news is actually bad news. And the fact that the Fed might drop interest rates just means that they're doing so not because they've solved inflation, but because the fundamentals of the underlying economy are very unsound and getting worse. So then all of a sudden they're like, holy cow, no, buy, buy, buy. No, 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 no. I'm going to sell, sell, sell. So then prices go down, they plummet of all assets. Pretty much what we've seen over the last few days. And keep in mind, you always see this type of volatility in massive bear markets, where you don't see just massive sell-offs. You also see huge retracements. So the market's down by, let's say, 1,200 points, then up by 800 points, then down by 500, then up by 1,000, bam, bam, bam. You see the VIX, the fear index, go through the roof, which, again, is what we've seen with this volatility. So prices go down, but that means the prices of the assets that all these globally systemic banks have on their balance sheet, specifically in Japan, go down as well, blowing a hole in their balance sheet, putting them on the brink of going bust, which is exactly why you have seen the share price of these banks plummet without the corresponding rebound that you saw in the overall broad index. But of course, if these banks are having problems, then that is going to heavily impact the economy, making things worse, taking us right back into that doom loop. So the main takeaway is there are many variables that are contributing to this GFC level of volatility we're seeing in the markets. But what the talking heads are trying to get you to believe is that it's all about the carry trade or the unwind of the carry trade. But I think an even bigger contributor to the fear index skyrocketing is simply what Bill Clinton told us in the 1990s. It's all about the economy, stupid. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I'll see you on the next video.